Hello friends, very good morning. Today I bring a new topic for you. The discussion for today's topic will be, for the general ledger, what are the interview related questions you may expect in an interview? Okay. As you have seen my last video, I have provided, you know, different cycles like the procure to pay cycle. You will have order to cash cycle, and then you'll have acquired to retire, then you have record to report. So these are like basic business processes. Now this series I'm going to cover all these module related interview questions normally, which are expected in an interview of Oracle Financials particularly. And here the audience will be who are the current Oracle Financials aspiring consultant, and the Oracle Financial, the junior, senior, any kind of a person who wants to learn, who wants to gain their knowledge in terms of how they should prepare for an interview, and what are the questions they are expecting from a interview perspective. So basically, in Oracle Financials, the five modules I cover: GL, AP, AR, FSCM. So out of these five modules, today we are going to discuss for the general ledger interview questions. Okay, here you go. So what is the first question is basically, what do you mean by chart of account? So COA, what we say in short term terminology, basically any ERP you go down, there will be chart of account structure. Okay, basically chart of account structure is nothing but how you are going to do your accounting. You know, what kind of requirement you'll have for configuring your chart of account, particularly we are going to discuss today. So basically, a chart of account is nothing but it will be, comprising of your company accounts, departments. I'm giving a hypothetical answer here. It could be any kind of a number of chart of account. It could be, so normally a chart of account could be two digits, two segments, three segments, or it depends upon the business. You can have five, seven, eight, any kind of a segment you can have in a chart of account. Okay, so there are four C's basically. Out of four C's, we are going to discuss one by one. What are the four C's basically, uh, which we require in order to configure the chart of account? Okay, so the first thing is that uh, basically you need a calendar, you need a currency, and you need to have accounting convention. Okay. Okay, so the four C's, I'll repeat here. You need to have a chart of account, basically the account structure, and you need to have accounting calendar, and you need to have a currency, and the last one is your accounting convention. So convention, in terms of what you mean by it, could be your accrual basis or cash basis. Normally, the standard process we go for is the accrual basis of convention. So standard accrual method, use it in terms of accounting convention. You have a currency. Suppose in India, I will have to configure my chart of account. My primary currency will be your INR, which is your rupee, and you need to have a calendar. Every organization follow a calendar, right? It's a yearly calendar once, and then you break it up in a month, like a month wise you will have a calendar, right? Monthly calendar we need to have for the GL. We could have quarterly calendar, we could have 445 calendar. So Oracle provide all sort of calendar. You can, based upon your business requirement, you can configure into the system. Okay, yeah. So next is chart of account. So chart of account is nothing but it's more of like it requires what are your account types, right? Accounts detail level, and all those elements, the company codes particularly, all those elements. So with this kind of a combination, you can create your chart of account with the help of four C's. Okay. Once a chart of account is configured, the next question will be what kind of a what is a segment particularly, right? So segment means basically, so segment means actually it defines the attribute of a particular, behavior of a particular definition of a chart of account actually. So, for example, I can say you a segment could be, in a chart of account you can have a segment. Say for example, starting with company, then you can have a department, then you can have a account, then you can have a product, you can have a market, you can have intercompany, you can have future one, you can have future two, like this. These are called basically segments. It defines what is the attribute of a particular segmental behavior of a chart of account, right? So company segment stands for its company specific definitions, right? Account segment defines its particular definition for accounting type, like I can have a revenue account, I can have expenses account, I can have a asset account or a liability account. Similarly, in the same manner, you can have cost center as a segment. In cost center, normally what you define more of like segment. I mean department wise. In any company, you go down, there will be finance department, HR department, there will be admin, there will be manufacturing, there will be so many departments will be there. So this is basically your cost center segment we say, right? So the third one is, what do you mean by segment values? So segment values is nothing but basically, if you see what are the values of a particular a segment. For example, you have a chart of account where say for example you have five segment structure, which is company, department, account, product, and intercompany. So like this, I have five segment structure. Now each segment will have values. So company will have its own values. What is the company definition? Say for example, 01. There is a company called a telecom company, and there is a different business segment company. You will have FMCG company. So those company definition you can define like 01 or 02 kind of, these are called segment values inside. Similarly, in department, you will have cost centers, right? Cost center department. You have finance department, HR, then you'll have admin. So these are basically your segment values, we say. Like in account, you can have your, in terms of like the revenue, expenses, asset, liabilities, ownership, all these accounts will be available. Okay. So, what are the account types and use of it? As I mentioned earlier, the account types, it is more of like there are five account types we maintain in a chart of account for the account segment, which is your revenue. First one is your revenue, and second one is your expenses. Third one is asset. Fourth one is liability. Then your fifth one is your owner's equity. To start with the sequence, how we do in Oracle basically, one starts for your asset, two starts for your liability, three starts for owner's equity, four stands for your um, revenue, and five stands for your in terms of expenses account. So this is the numbering that we normally define. So this is called various account types. Normally this attributes you need to define for each account. Whatever account you define, we need to provide this kind of definition into the system. Explain about the calendar. So basically we have two types of calendars into the system. One is your accounting calendar, and the second one is your transactional calendar. Okay. So basically in accounting calendar, when you can have a normal accounting calendar or a fiscal year calendar. In India, we maintain April to March is a fiscal year calendar, and in other countries also you can see like apart from April, March, January to December is normal the accounting calendar year, or it could be July to June also. So if you go by different geographies, different country specific, they have a different accounting calendar structure. It will be 12 calendar, and you can have adjustment calendars you can define within that particular accounting calendar. That possibilities are there. So normally system provide either you can have your um, adjustment period, either opening of the year, you can define it, or you can create that adjustment here in the closing of your period. So anything is possible it all depends upon the business scenario. So transaction calendar is basically is to define the working days and the holidays. Basically this is required only for the manufacturing related companies when you'll have basically 5 working days calendar and 2 days off calendar, so there'll be no business. So in that transaction calendar you can define into the system. Okay. For the finance specific, for the chart of account you need to have a accounting calendar particularly, okay, not a transaction. So let us see what is the difference in between this chart of account structure and chart of account structure instance. Okay. Basically, in Oracle Cloud, the moment you create a chart of account structure, right, you mention all your segment and definitions under a chart of account structure, which you plan to, use it or not use it. But that will be comprising of your chart of account structure. I would say I'm having 10 segments, okay, defined under chart of account structure. It may happen I do not want to use 10 segment in my current scenario. I want to use only 8. So what happens is that in the chart of account structure instance, you can define, there is a option that you can have your 8 segmental structure. You can define and carry on your activities. And in other case, like instance works about the structure, and it regulates the structural chart of account at the instance level. We need to define whatever chart of account structure already you have defined at the instance level. Again, you have to enable those particular segments, so that will be available to use in your structure. It may happen that you may have multiple segment where it is required and not required by particular country specific, so that you can take a call based upon the business requirement. Okay. Explain about the primary and secondary ledgers. So primary ledgers nothing but is the primary set of books. Normally you define with the help of chart of account. We define a ledger where we are going to do all your postings particularly. Okay. So in a way you can say primary ledger is the ledger where you maintain your general ledger along with your all sub ledgers, like the business unit level sub ledgers. You post all your journal entries and then transfer it to the primary ledger. So primary ledger, holds a very important role. Any business, anywhere you go down and do implementation support, there will be primary ledgers by default. Because post is once you create a chart of account, you cannot post it within a chart of account just like that. You need to have a primary ledger in order to do your postings and reporting out of it. Okay. And what do you mean by secondary ledger? So secondary ledger is basically required as per your requirement. If anything, I do not have I have the feasibility that I can, define within the primary ledger, and I need to have a definition called, apart from my primary ledger, if there are different currencies, if there are different calendar structure you have, right? In terms of defining that into the system, normally you opt for a secondary ledger, where particularly in terms of reporting, in terms of business requirement, the tax purpose, the local or statutory tax requirement, or in fixed asset you have a tax book. So in the general ledger you can have some kind of statutory body related requirements. So it all depends upon a business how you want to portray the differentiation in terms of the primary ledgers and secondary ledgers reporting. Actually, these two are basically defined as per the business. Primary ledger is essential, I would say. The secondary ledger, it all depends if there are something in terms of business reporting requirement which cannot be fetched, or the scenario which I mentioned, you have a different currency for the reporting side or anything. It could be right for the calendar. You have a different one. You can go for a secondary ledger. Okay. Now next, go down to the reporting ledger. So basically, say for example, I'll give an example here. Now, our company based out in India. So basically, we run on the primary ledger with the INR currency, and our reporting company stands out to be in the UK or US. So definitely, you have to follow the their currencies in terms of the reporting ledgers. So what happens is that we have to convert our balances from the primary ledger to the reporting ledgers in terms of reporting our balances like trial balances, all these values at the end of the month into a reporting ledger, and then you send it to your parental company for the reporting needs. What do you mean by translation? Explain the setup with the company. Basically, translation is nothing but you need to translate your values, right? Your base currency to a reporting currency. So basically, in a month, and we do these translations. So translations means by like what are the setup configuration you can go through your requirement like what is the setup that you require for the translation. I mean, it's more of like you need a you know period end rate and period average rate and the historical rate basically for the translation purpose. Why you need period average rate? Average rate is required to translate the values for the revenue and expenses items in particularly. Okay, and you need the period end rate particularly for the um, assets and liabilities accounts which needs to be translated all these values in the end of the month. And if you have any kind of owner's equity account, right? So those things will take up the historical rates particular. So these rates, when I say period end rate and average rate and the historical rates, so these in the currency, definition, managed currencies, you go and define period end rate average rate into the system. Then in the, a ledger option, specify ledger option, you have to mention those, all these definition in the translations. And there is also one account that we need, which is the cumulative translation adjustment account that you need to set up in the specified ledger option. So all these elements we need to define in terms of our translations. Okay. What do you mean by revaluation? Normally, if any kind of a foreign currency transactions happens in our system other than your base currency or the local currency, then you need to have revalue your balances, your those particular accounting transactions in terms of like uh, it's in terms of revaluing those foreign currency transactions end of the month. So the impact you can see in terms of revaluation will be there will be accounting entry which is gets journal entry gets generated in the end of the month, and that subsequently we do reverse in the next month. Okay, so revaluation you have to provide more of like the realized gain and realized loss, unrealized gain and unrealized loss. Those accounts we have to provide. System is going to calculate those revaluations based upon the foreign currency transactions. Okay. What do you mean by consolidation? So what happens is that if you have 4 or 5 countries across the globe, right? Then you define these primary ledgers for 5 different countries. So basically, how you are going to consolidate of all your primary ledgers data. Somewhere you will have to consolidate all this data. Then only this data you will have a consolidation, trial balance. You have to have a consolidated P&L and the balance sheet. As I said, there will be parent company, right? Parent company will have hold all these sister companies or the subsidiary companies in the across the country. So what they do in terms of like particularly when you say consolidation, they pull up the data from each ledger, country specific ledgers into a parent ledger, and the parent ledger they figure out the consolidated the figures which is end of the month or end of the year. Depends upon the reporting requirement of the auditors, the stakeholders, particularly, or for the government bodies, right? So basically, this is how your consolidation happens. In terms of setup, you can refer to the Google Docs or Oracle Docs. The next one I'm going to discuss about the KFF and DFF. Basically, key flexifield is the mandatory information. By default, you will have to provide this, key flexifield into the system. Okay, and DFF is nothing but descriptive flexifield. It is purely optional based upon the business requirement. We define DFF into the system. If in GL you will have accounting, key flexifield is there, and DFF like as for the business it's a business need. I can define a DFF. The scenario will arise only you know when you have probably in terms of journal, I'm saying, right, I wanted to have some kind of extra informations from the user perspective. So I need to create a DFF field for them, right, to capture those extra informations. Apart from that, whatever Oracle provided informations. So in that scenario, we are going to create the DFF particularly. Okay. So this is it for today. Wait for another, session. We are going to cover another like set of questions for the GL. Thank you for watching. Have a wonderful day.